welcome to Property Matters here on Dublin South FM. You can contact the show on Twitter, Facebook or LinkedIn at iPropertyRadio or email hello@iPropertyRadio.com. My first guest today is Martina Hennessy, Managing Director of Doddle. Martina, you're very welcome to the show. Tell us about Doddle.
Thank you, Carol. So Doddle is a mortgage broker. So we have access to 8 major lenders under one roof. So we would offer mortgages for clients who are purchasers, so first-time buyers and movers, and also a huge element of our business would be switchers. So people who have an existing mortgage and are looking to switch to save on interest. So we have a digital platform that allows you to see on our site what you can save by switching or what your repayments would be if you're looking to take out a mortgage. And then we offer an end-to-end digital service where our clients will complete an application in digital format. They will upload their documents, and we would work then on, we have a team of specialist mortgage advisors who'd work to find the best mortgage for their personal options. We're regulated by the Central Bank of Ireland, who monitor the work that we do in terms of the clients, when they come to us, what product suits them best and the reason why they would take a mortgage with a particular lender.
Very good. Martina, most people will have heard of Doddle if they listen to the radio in their car at all. Because for the last number of years, you've had a really catchy kind of ad running across Irish radio.
Jingle. I won't sing it, Carol, but yeah, it is a bit of an earworm. People either like it or love it or hate it. And I think maybe we could be kind of a par on that. I'm not sure, but certainly it's one that my kids go around the kitchen singing. So yeah, it must stick in somebody's head.
You know what? I love it. Before we came on air, you mentioned that your kids brush their teeth to it, and I think that's fantastic. So now when I hear it on the radio, I'm not just going to think about the service. I'm going to think about actually getting your kids to brush their teeth as well. So I think that's a great one. But but the reason I mention it is that it's so difficult with something like mortgages. People tend to think that there isn't much difference, and I think anything that you can do to stand out and say, well, actually, no, it's not business as usual here. We're taking a different view or a different approach to the mortgage market. I think that's a really powerful tool, and that's actually why I wanted to speak to you today. So before we get into kind of the specifics of Doddle, you might just give listeners an overview of the mortgage market. It's been a bit of a confusing time out there in the mortgage market.
Yes, so absolutely, Carl. So there's 10 lenders at the moment in the Irish market. So it's a small market in general. The number of mortgages drawn down on an annual basis are relatively low. We're like Manchester, effectively, if you look at the numbers. So there doesn't need to be a huge number of banks in the mortgage market, but there definitely needs to be competition. And over the last number of years, we've been lucky enough to have some new entrants, such as Avant Money, ICS Mortgages, and Finance Ireland. So they're new players that are coming into the market. They don't have a branch network. They don't have a back book of trackers and arrears, and so therefore they have the same regulations, same capital requirements, but they're able to lend at a much lower level. So you've seen some sort of a shake up in the market. Then the last 18 months rates have really reduced, and then you have the main players like Bank of Ireland, AIB and PTSB, who hold most of market share. We've been really I suppose unlucky to, for want of a better word, to have seen the exit of both Ulster Bank and KBC, or the exit that's going through for both Ulster Bank and KBC, with Ulster Bank's loan book being transferred or sold to PTSB and KBC's to Bank of Ireland. So Ulster Bank and KBC were some of the more competitive lenders on market over the last number of years. So anything or any lender that leaves the market, particularly the mortgage market, where they have offered lower rates in the past, is a real loss to the consumer. So I suppose the market has contracted slightly in terms of KBC and Ulster Bank's exit, even though KBC are still lending. Ulster Bank are lending to Ulster Bank customers. But, we really need to look now as consumers and say, okay, these new players that have come into market, the Avance, the ICS, the Finance Ireland, they're offering lower rates. They're offering longer mortgage terms. They're offering overpayment on rates. We need to look outside of the standard pillar banks and really try and increase competition in the market, because competition in the market is the only thing that will create discipline and ensure that lenders maintain rates, that ensure that lenders are competitive. As Irish consumers, there's a real lack of switching in the Irish market. Thankfully, there's been a surge in switching numbers over the last 2 years, but really it's really important for Irish consumers to take control over their mortgages. Once you take out your mortgage, it's most likely your largest financial commitment. So it's really important that you take control of that and try and reduce your interest as low as possible. And that means shopping around for better rates when it's right to do so.
Okay, Martina, there's so much in what you said there that I definitely need to break it down, because I love that you're encouraging people to take control of their mortgage and their financial life, because I think that's something that's been really lacking in this industry. So that, and I say that from a personal and professional perspective. So we definitely want to talk about that. Ulster Bank and KBC leaving, I definitely want to talk to you about what the implications are for current mortgage holders. But you mentioned something there that has been a bit of a bugbear of mine over the past number of years, and it's something that's come up in media maybe every year or so. But lack of competition in the market. That you talk about how greater competition in the market will bring a greater discipline, and that's what we want to see. But competition in the market when two of our fairly large mortgage players are exiting, and it doesn't seem like we are a welcoming market for European providers. What can we do to increase the competition in the marketplace?
Yeah, I suppose if you look at it, the good thing about the last number of years and the new lenders that have come in, they've come into the market and there's been a lot, they've done better than they expected to do. So if we look at the numbers that were underwritten by say Avant Money, by ICS, their numbers have been announced recently. They doubled what they expected to do in the Irish market initially when they came in. So that will be encouraging for other entrants to market. It is expected that there will be new entrants to market this year. Moco and First Citizen may enter the market once they have a license to regulatory license. There's also like options for digital players such as N26, Revolut to again provide mortgages in the Irish market, and that would be fantastic from a competitive point of view, even on the switching side. So even on the switching side to create more, I suppose, competition in the market, reduces rates. So it's certainly something that is welcome, but again, the size of the Irish market is restrictive, so it's not appealing to many other lenders to come in. Also, the level of funding that we have to hold for mortgage lending in Ireland, it's 3 times the level that would be in, say, Germany, for example. So that's costly to banks. So when banks are looking at the Irish market, they're saying it's a small market. How can they manage their costs? How can they manage? They can certainly introduce low rates because, again, they can access low rates on market. But it's just in terms of lending, will there be enough to sustain and to have that, I suppose, that breadth and depth to be able to lend in a constructive manner?
Martina, you've mentioned 2 players there, one potential and one financial services that could potentially enter that I haven't heard of before, Moco and N26. I think most people will be familiar with Revolut and possibly even First Citizen. And it was interesting just this weekend to see Revolut going into the pet insurance.
Yes.
So pet insurance to mortgages, I don't know, is that a big leap? But Moco and N26, I've never heard those.
I suppose Moco, it's been in widely in the press that they are entering the Irish market this year. They're awaiting regulatory license. N26 is just a digital player out there that could potentially easily access, given the number of account holders and the number of consumers they have in the Irish market. That's, I suppose, further down the line. If you look at it, it would be like Revolut coming to the market. They'd be able to offer a kind of a digital proposition to consumers. They have a very strong Irish consumer base. So it would be, as you see the evolution of insurance products, you may see the evolution into mortgage products if they can kind of, as an additional service once they get their structure right in terms of how they lend and their regulatory position in order.
Okay, and again, I presume we want to see as many new players coming into the Irish market as possible.
Well, I suppose we want competition within the Irish market. So when you have market share in the main being held by 3 players now, so with PTSB, AIB and Bank of Ireland, we need consumers to look outside of those main pillar banks and look at the new entrants, look at the lenders that are offering the lower rates and, and take your mortgage with them if you're looking to take out your mortgage. There's a massive difference between rates on offer by lender. And if we look again at some of the lower level lenders and the new entrants to market, they're offering rates at 90% finance of 2.25%, where the main players will be up towards 3% for the exact same product. So I suppose what I'd say is when you're taking out a mortgage, I know people are nervous when they're taking out a mortgage as a first-time buyer or a second-time buyer, and they want to get a mortgage and they want to get it for the level they want. But just to be aware that there's multiple players on market, and that's why getting advice from a broker is key, because brokers offer market-based advice. We offer advice across a range of lenders, and the idea and I suppose the objective of a broker is to find a mortgage that best suits your needs. So we all are aware of the central bank rules and the central bank limits on lending, and that they're restrictive. So anybody who's buying in an urban area, they'll be aware of what exceptions are, and exceptions are available across all lenders. But really, if you're looking to take out a mortgage, it's important to understand what each lender will offer you, because it varies by lender based on variable income, based on, if you've bonus or commission or overtime. So it's important to shop around when taking your mortgage, both from a mortgage eligibility point of view, but also in terms of rate.
Well, we'll get on to the wider issue of shopping around in a moment. for those mortgage holders who are currently with Ulster Bank and KBC, what options do they have?
Yeah, so while they're with KBC and Ulster Bank, if they're on fixed rates or if they're on a variable rate, until their mortgage is assigned, the rate would still apply. But even after their mortgage is assigned, if you're on a fixed rate, for example, with Ulster Bank and you're partway through that, that rate will continue to apply even if your mortgage is assigned or sold to PTSB. So there's no immediate urgency to switch your mortgage. However, some of the lenders are now offering switcher packages for the exiting lenders, I suppose, to encourage lending, to access new business. But those lenders also have low rates. So I suppose if you look at it, KBC and Ulster Bank were some of the lower rate lenders. So in terms of switching to another lender, the savings may not be vastly different to what you're repaying now, but what you're locking down is certainty, because what we do know is Permanent TSB and Bank of Ireland, who those loans are being sold to, they have some of the higher rates on market. So you'd be going from a lender that has had some of the lower rates, being KBC and Ulster Bank, to a position where when you roll off your fixed rate, the rate that would apply would be the lender that now owns your loan. So if that's Bank of Ireland or PTSB, their rates as it stands would be higher than much higher than some of the other lower cost lenders on market. So many people are taking charge. They're saying, okay, well, when I'm switching my current account, I'm going to start looking at switching my mortgage. And so that's why this year in 2022 will most likely be the year of the switcher, because we'll see so many people who have been prompted, they've had to switch, whereas consumers in Ireland, we're kind of need to be pushed to switch. So it's a funny one. Even though there's such huge savings to make by switching, unless our hand is nearly forced to do so, such as the case of exiting lenders like Ulster Bank in particular, where their current accounts are now being transferred to other providers. We nearly need to be forced to do it, where we should be proactive in looking at our rate at regular intervals to see if we could save.
Martina, why is that? I mean, I heard you say that there has been a surge in switching, which is great, but that actually there is a certain apathy towards switching. We tend to just accept the rates. We tend not to look outside. So I'm really interested in the psychology of switching and why we don't do it. And it's something I think 10 years ago we were having a conversation about why people don't switch the utilities or their home providers. So this is not mortgage specific. But is it Irish specific?
You know what? I suppose that the big thing is with switching. Yeah, I think we're a loyal consumer. The Irish consumer is loyal.
Loyal or lazy? Genuine. Is it loyalty or lazy?
Yeah. I think you know what? I think it's now's the time, if you were ever going to look to switch because of the increasing cost of living. Now's the time to make sure you're paying as little as you could possible on everything to do with your household. We are good at switching utilities, at switching our insurance, etc. But the big ticket item always, and the one that we'll always call out, is your mortgage. If you're a homeowner and you have a mortgage, the one thing that will come out of your bank account, apart from childcare sometimes, but is your mortgage. It's your big ticket item. So that's the one to look at. And I think, Carl, a lot of people don't appreciate the huge savings that can be made by switching, or they feel, oh God, sure, look, at the banks will always win out in the end. But when you have a mortgage, the big thing is you have to take control of it. You have to be so proactive in looking at your rate. And I think there's I suppose, an emotion involved where you think, God, when I purchased my house, it was so difficult. I had to find a property, I had to get the level I wanted to get to buy, and you associate your mortgage with your home. And also, obviously, from an emotional point of view and a security point of view, we consider we tie in our mortgage again with our home, and we think, God, I don't want to put my head over the pulpit or rock the apple cart anyway. We want to just stay. We have the mortgage now. And really, I suppose, when you have a mortgage, if you're looking to switch and see if you can make savings, that's you taking control of the mortgage. It's nothing to do with your home. Your home will still be your home no matter what. Even if you explore switching and you decide, you know what, it's not for me, or I'm not going to make a saving, whatever, you need to do that. So mortgage statements are issued in the first quarter every year. So most people get it, shred it, file it, bin it, whatever it is. But the big call out is when you get it, open it up. I know when I opened mine, I even have a tracker rate. I looked and went, oh my God, this thing goes down so slowly. You get to a stage in life, Carl, where you're kind of trying to pay off the mortgage as opposed to look for more debt. And I think, the big thing is to look at that mortgage statement, look at the balance, look at the interest rate, and then go onto the CCPC website, go onto the Doddle.ie website and see if you can save by switching. It take you 2 minutes to do that and you could save thousands, but at least understand what rate you're paying, because the only way you'll know if you can pay less is to know what you're actually paying or what your interest rate is.
I think you touched on something really important there, and that is people have the idea that, you call it emotive, or the emotion around it. I would go so far as to say, in some cases, the trauma around your first mortgage application, and it is wrapped up in the paperwork and the hassle. And I say this from, a decade ago when I was working with home buyers every day. There was a huge amount of trauma locked up in that first process. As much and all as you want the process to be a positive one, it really isn't. There's a lot of fear, there's a lot of relief when it goes through, and it's probably something that people can't separate the mortgage transaction from the home, purchasing a home, the moving, the negotiations, the being outbid, everything else. People don't seem to be able to separate it. So actually, there is a certain amount of trauma there that people might not want to revisit this. So
Yeah.
whatever it is, they accept it, and as you say, file it, shred it, bin it, but they're certainly not going to engage with it to see if they can make it better. I mean, is it a case that we've been conditioned to accept, that we have the highest interest rates across the Eurozone? Have we just been conditioned?
Yeah, but I suppose there wasn't an opportunity. So back in the recession, there wasn't an opportunity to switch because so many people were in negative equity. From 2015 onwards, then mortgage holders, the loan to value started to increase because, the property market was coming back slightly, but also the banks introduced, switcher packages and switcher products, which allowed us, but it's taken a number of years for people to understand that it's not just the financial whiz kids in the know that can do this. It's everybody should be doing this. And actually, like, it's savings that you can make by switching. Interest adds no value to your mortgage. We almost, as a consumer, feel like our mortgages are like a tax. They come out of our bank every month. There's nothing we can do about it. We just have to pay it, and that's it. Whereas every other expense we analyze, and again, mortgage being the biggest expense, it's the one that we should be have our eyes all over and be looking to do as much as we can. And the power is back in the hands of the consumer. Absolutely, as you say, people are, traumatized about the whole first transaction of trying to buy because it is so emotive, and especially now when it's so difficult for people to buy homes. But again, I suppose once you have your home, that's that's totally separate to your mortgage, and it's just a transaction. And the only emotion you should have once you switch your mortgage is like, thank God I did that, and smug that you've saved money.
I love that smug is the term you're using there. I think I can see that people would identify, that they want the relief, but again, there's a perception out there, and in a way, is it fair to say that the banks or the lenders are rewarded for being pretty poor to deal with and having a pretty poor and lack of digital process? Because if it was very easy to switch, I think people would do it more often. So actually, in a way, the banks, they likely don't have a motivation to improve how people engage with them, because by not engaging well, you keep people locked in. And quite frankly, we know telecoms providers who have used that strategy to retain customers over the past decade. So I mean, is it a stretch to say that about the banks? Am I being unfair?
Yeah, well, I suppose the central bank, in a recent enough review, did look at our lenders giving enough information to customers at the end of every year to say, these are the other rates we offer. What used to happen after, and what still does happen unless you elect, is after you are on a fixed rate, if you roll on off your fixed rate, you roll on to a standard variable rate, and they can be up to 4.5%. And as consumers who aren't actively reviewing our mortgages, we tend to roll on to a standard variable. There's over 200,000 households on standard variables paying up to 4.5%. So on your mortgage statement, you should get a list of other rates that are a section that will set out other rates that could be applicable to you. But again, we don't tend to actively take those up. So even if we're getting a statement from a lender to say, this is what you're paying, but these are the other rates you could pay, even if we know that they're lower, we're reluctant to change. We're reluctant in case we make the wrong decision. I think sometimes when we're presented with a number of options, we're I suppose nervous to pick an option unless, because we're the fear of the unknown, or fearing making the wrong decision. And I think that's why you need market-based advice. Like, clients that come to me, they're teachers, doctors, nurses, whatever it is, I couldn't do their job. And, you have to come to somebody, you have to go to somebody who is an advisor in that area, because mortgages are technical products. They're technical products, and you need to have assistance going through a process of either purchasing or switching. And just in terms of the point, I suppose, in terms of the documentation piece. So there's a regulatory requirement for all mortgage applications that you have, that the banks, from a consumer protection point of view, make sure the mortgage is affordable, and sustainable. So when you're making a mortgage switching application, you absolutely have to go through some documentation that's required, and that is as extensive to some degree in terms of pay slips and bank statements as when you made a mortgage initially. But the big thing being that you have that mortgage, you're paying that mortgage. So that shows your affordability. You don't have to have savings. You just need to be able to show that you can meet the mortgage repayment. So what I would always say in terms of the documentation piece is that if you look at it, the number of hours you might put in terms of putting together a mortgage application to switch versus the saving that you would make. So we do an index every quarter, and we take, the average mortgage drawn down and the average savings. So quarter 4 2021, taking an average mortgage of 267,000, you can save up to 4,308 euros a year by switching, and that's just in 1 year. So for the 6 hours you might spend on paperwork end to end, and we've calculated that with our clients, it's not a bad return. So it's something to sit down and work and is worth doing. But the big thing is to get advice, because I think if you start through that journey yourself and you're saying, okay, AIB is offering me this, Bank of Ireland's that, what should I do? You'll end up kind of getting a bit, overwhelmed by it and pull back. So it's so important to get advice when looking to switch. Again, you don't have to switch. You can go through the process of understanding what rates and terms may be on offer to you, but you don't have to do it, but at least know what's available. And if you're somebody who will say, I am never going to switch, or I can't switch, or circumstances have changed, then at least call your own lender and say, well, I'm on this rate. Is there anything better you can offer me? They are never going to come to you and force you to take a lower rate. So you have to be more proactive in looking to access a lower rate, even if it's with your own lender. At least do that. That's a phone call. That's something that could save you thousands of euro just by making that phone call and taking control over what your rate is.
And we're having this conversation at a time when certainly for January, the cost of living and rises in the cost of living have overtaken the housing crisis in the national conversation and the political conversation for the first time in years. Do you think that that's likely, because we're told that, we're told routinely that Irish homeowners are paying the highest rate across the Eurozone in terms of interest rates, but with interest rates globally set to increase and the cost of living conversation happening, it doesn't take a huge stretch to say, well, that's likely to run into mortgages. The fact that our mortgages might be the next thing to be felt in terms of the impact of this increasing cost of living, do you think that will change the mindset of people? Will that make them undertake this 6 hours of paperwork in order to get that kind of return?
Yeah, no, absolutely. We see that every day, Carl. It's people coming to us saying, we're worried that rates might start to increase. They're reading in the papers. Christine Lagarde last week said that they couldn't rule out a rise in European borrowing rates, which would mean that rates will start to increase. So more and more people are kind of saying, okay, well, I want to lock down a good rate now. Mortgage interest rates are the lowest they've been in Ireland in the last 12 to 13 years right now. So if we look at it, if we're starting off from a really low base and where rates have reduced in the last 24 months substantially, and introduction of green rates, etc. So there are some really good rates on market. It's a really good time to look at rates. Irish consumers have always favoured 2, 3, 5 year short-term fixed rates, and that's because really above that they weren't either available or they were extremely costly. So I suppose if we look at it now, again, the new entrants that have come to market have brought in fixed rate terms right up to actually 30 years if you wanted to, but there's 3, 4, 5, 7, 10-year fixed rates that have really good value at the moment. So if I was a consumer and I wasn't on a tracker rate, because trackers are so valuable, I wouldn't encourage somebody to fix if they were on a tracker rate. But if you're not on a tracker rate, you should be really looking and saying, okay, well, what rates are out there? What can I access? And the big point being, if you're looking to fix your mortgage, don't just fix with the first lender that comes your way, because if you're fixing for 5, 7, 10 years, if you get that rate, if you're paying more than you need to on that rate, it's not just in the short term, it's for an extensive period of time, and that will mean that you're paying a lot more than you need to. So I suppose I would, 84% of the market who drew down mortgages last year took fixed rates. So they're undoubtedly more popular than variable rates. They're actually lower than variable rates right now. But if you're looking to fix, I suppose, look at the longer term fixed rates. It might be a good opportunity to do that. Also understand if your proposed lender is going to allow you to overpay on your mortgage. Because if you're fixing for 5, 7, 10 years and you've the means to overpay, it makes such a difference to the interest that you'll pay on your mortgage. Not all lenders allow overpayment while on fixed, so you might need to split your rate, part fixed, part variable. But understand if your lender will allow overpayment, and then understand the break position. Like, so if you break out of a fixed rate early, you could have a break penalty. The big thing now being that the cost of funds is so low, the break penalty is related to the cost of funds when you lock in versus when you break out. And because the cost of funds is so low, it mitigates the risk of a penalty, but it certainly doesn't negate it. So just be aware that there can be a penalty if you break out of a fixed rate early. If you're in a home that you're going to be in for the long term, perhaps it's worth looking beyond that 5-year fixed, which we normally look at, go to 7 or 10-year fixed rate. The big point being, make sure you research the market and see what rate is lowest for your loan to value. So what's the lowest rate you can achieve? Because otherwise you'll be paying a lot more if you're fixing for a longer term than you would if you chose that lower rate.
Okay, Martina, just before we finish up today, because you've definitely made it sound like there's a huge range there between the highest and the lowest. That's not never the perception of the mortgage market. So can you specifically kind of talk us just through that range?
Yeah, well, I suppose, if we look at it, many of the standard variable rate holders, so we discussed that there's like 100,000 people, or sorry, 200,000, over 200,000 people on standard variable rate. So they can be up to 4.5%. The lowest rate then on the market is 1.95%. But if we take any range in between, so if we talk about the top end, okay, so the first time buyer taking out a mortgage at 90% finance, they could access a 3-year fixed rate at 3%. And probably one of the lenders who have the highest market share has a 3-year fixed rate at 3%. And then some of the new entrants are at 2.25%. So the difference on that is huge for mortgage holders, okay? If we look and again say that the consumer, when we look at our index, that 267,000 euro mortgage, the person on paying the higher rate versus the lower rate is paying 4,300 more a year. So there is a massive range. But also the big important point, Carl, is we have seen double-digit home inflation over the last number of years. So when you look at rates are tiered by loan to value. So what that means is the lenders take your mortgage amount versus the value of your home, and they will give you a rate based on a threshold. And generally it's like, less than 60%, 60 to 80, greater than 80% loan to value. When you hit 80% loan to value, the drop in rates is hugely substantial. It's almost 0.5%. So where somebody has purchased a property, even as recently as 2020, or 2020, sorry, their loan to value is going to be so much stronger. If they borrowed at 90% at that time, because of house price inflation, their loan to value should be at 80%, and they can lock down a much lower rate. So I suppose that's a consideration. The big difference between the lenders: don't just accept the first rate you're offered. Make sure you understand what rate you could get for your loan to value. And again, that's the mortgage divided by the value of the property, can differ so widely. Again, we could take the example of somebody with 60% loan to value. So a lot of our switchers, if they're switching, they've built up equity in their home, they're opting for the lowest market rates, which are 1.95%. They are coming from lenders. And at the weekend, I had a client who is paying 3.9% as a variable rate, and we could switch them. And it wasn't even to the lowest market rate. It was to a 2.05% rate. And they were saving 595 euros a month. And it's like, I know that's like, it's like, for me, it's incredible. Like, it's like somebody coming up to you and giving you 12.50 euro notes a month. I'd love it. There's a lot I could do with that, but it is amazing. I know that's just one example, and not everybody says at that level, but certainly it's just, for me, I'm probably a sad mortgage nerd, but I get very excited about the fact that is what somebody could save. Because if you don't do that, the bank is just eating up that money in interest. It adds no value to you, no value to your mortgage. And it's so important just to be so active in terms of your mortgage interest.
Martina, I can just visualize somebody walking away with 12.50 euro notes. That's a very powerful way to share that. Now,
Carol, a month.
There's the feeling of being smug. If you can get that into your hand every month, that you've earned the right to feel smug. Martina, thank you so much. Look, you've actually opened my eyes in terms of the opportunities that are out there, but more importantly, probably the accessibility of those opportunities. That
Absolutely.
maybe it's not as difficult, and that the range is much broader maybe than consumers realise. So thank you so much for taking us through that. That was Martina Hennessy, Managing Director of Doddle. We need to take a quick break now. Stay tuned.